It's that time again. Major U.S. economic data hangs in front of markets, and they are reluctant to move until it is out of their way. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are going to break down what will be probably the biggest piece of fundamental or economic event risk for financial markets this week, the incoming U.S. CPI inflation report. We got a little bit of a preview today with the wholesale inflation number, and that had an interesting response that we'll take a look at here. And then, of course, break down what's on the menu for CPI and what it might do to influence these markets as we try to trace next steps. So first, just take a look at this intraday chart of the S&P 500. This is benchmark ES futures, the active contract. And really all we're looking at here is just how responsive markets were to the wholesale inflation data that we saw today, or alternatively, not very responsive. So this is it right here. Now you can very clearly tell that markets were quiet, they were quiet, they were quiet, and then they weren't. So you can clearly see here that the markets did, in fact, notice the number, respond to the number, and trade on the number, then had a volatile session back and forth, and ultimately landed where the number left them. So very clearly, there was a level of response. There was a reaction function. It just didn't last. So why did stocks pop on this data? Well, of course, this is a great illustration of what the markets care about at this juncture. Of course, we saw that last week the markets took quite the beating, over 2% of a drawdown in both the S&P and the NASDAQ last week, and a surge in yields, a steepening of the yield curve. All of that thanks to economic data that made the Fed appear like it would be even less dovish than even the Fed itself signaled when it backpedaled on September's rate cut outlook with its December update. So what happened with this PPI data was very interesting, and of course comes in the context of what happened last week with very strong ISM service sector numbers, as well as a much stronger than expected U.S. jobs report, which is how we got those losses in the S&P and the NASDAQ last week, how we got the shift in Fed policy expectations last week, and of course how we ended up with this sense that this is what the markets now care about. Now, for the PPI report, the numbers were a touch lighter than expected. They were seen coming in to 3.4% on the headline from 3% in November. They came in a bit lighter at 3.3. The core PPI number that was expected was 3.8%. That's the reading excluding volatile food and energy. And it came in actually at 3.5, which is meaningfully lower. The prior number was revised from 3.4 to 3.5. So this ended up being a hold of November's reading rather than a meaningful advance on it, which is what was there in the forecasts. But nevertheless, these are strong numbers. 3.5% for the core is the highest in 22 months. The headline at 3.3% isn't as hot as expected, but again, the hottest in 22 months since February 2023. So these are certainly hot numbers. And so that it was a little bit lighter was registered here, but ultimately the markets didn't really take a big sort of view on this, didn't really show a lot of conviction, because of course a larger, more directly relevant piece of information is now in view. And although clearly this demonstrates the dynamics still work, which is to say those things that make the Fed appear like they'll need to be less hawkish is good for stocks, good for bonds, negative for yields, negative for the dollar, and whatever makes the Fed appear like more hawkish policies in order, that's aiming in the other direction. And those things still work. They've carried over from last week. The question now is, are you going to get a real catalyst to really make a move on something? And of course, that's exactly what we have by way of the consumer price index measure here, due in less than 24 hours. Expectations for a fourth consecutive month at 3.3% for the core. The headline seen rising to 2.9%. That would be the highest since July of last year. Now, this, of course, speaks to exactly the kind of thing that stock markets should dislike. And indeed, leading figures seem to reinforce that there is likely to be something of an upside bias. So we saw, of course, with the release of the ISM numbers last week, the really jarring part of that report wasn't even the headline surprise, but the price growth component, which you can see here, marked a sharp move higher and gave us the steepest pace of price growth in the service sector, the place where it matters most, as we can clearly see here. Inflation in goods, negative. Inflation in energy, negative. Inflation in food, a pittance, just a little bit of a sliver. And almost everything that's left of inflation is sitting in core services. So that we see this kind of a surge in service sector price growth is, of course, understandably a big deal, especially when we consider that lagging CPI and, in fact, the PCE price index, the one that the Fed looks at even more closely, lagging them 2 months to this ISM reading lines up pretty clean and suggests that indeed, if this is what ISM is showing, then perhaps a similar something is where CPI is heading. Moreover, if we take a look at how the realized results for CPI, especially at the headline, have performed relative to the Cleveland Fed's very closely watched forecasting, and it's a little bit choppy at the core. That makes some sense. It's, of course, excluding parts of the story, and so things are perhaps not quite as clean-cut relative to this particular model. But when we look at the headline here, in the yellow is the forecast, and we can see that the expectation for where we're currently going, if we sort of weigh up what this model is suggesting, the number that we're expecting to see for December at the headline is in fact 2.86. And the forecast, as we just saw, is 2.9. So the model is calling for an outcome about in line with expectations. Here's that 2.9 right here. But if the tendency, as we can see here, is for the yellow line to run a little bit under what realized results have been over the past several months, we can see the blue line exceeding the yellow for the past 3 months, then there's scope for an upside surprise here, perhaps, and though it might be a narrow one, that could be enough to inspire markets. Moreover, we can see that generally speaking, besides just inflation data, U.S. economic outcomes on data releases have once again started to improve relative to forecasts. There was a kind of cool down period here where there was very strong outperformance from late August through mid-November. And it seems like since then, models have been readjusted and retuned such that forecasts started to more closely align with realized results, but the U.S. economy has now outperformed even relative to that. So once again, we're starting to see data tend toward increasingly stronger readings versus the consensus, all of which seems to line up to the risk that CPI is hotter than markets have penciled in. Now, for the Fed, this is, of course, not the thing you want to see. Because if we look here at what policy officials often weigh up as they make their decisions, the sort of run rate on inflation, you can see that basically since the middle of the year, 3-month annualized inflation has accelerated. That's the blue bars right here. 6-month annualized inflation took a bit longer. It was still cooling here into September and even a little bit into October, but come November, it started to reaccelerate again for an even more significant sort of a pressure upward. Looking at the core, again, this is where the Fed is most interested because, of course, everything now lives in the service sector as far as inflation is concerned, and because, of course, the Fed has very little agency over global food and energy prices in any case. These yellow bars, the 3-month run rate on core CPI, that's been increasing since July into August. August was the first uptick here. And for the 6-month rate, we can see it sort of started to stabilize out around August, September, and October, but is already higher come November. These, of course, are very challenging trends for the Fed. We can see here the markets have moved accordingly. So since the Fed issued that very dovish outlook in September, the markets looked at it and said, well, there's no way you're going to do that with inflation doing what it's doing, and started to reduce the priced-in outlook for rates. Note, when the Fed came out in December, it said it was going to cut 50 basis points in 2025. That's half of what it said in September. So the Fed is not oblivious. They are moving in this direction. But now the market is expecting just 50 basis points for the 2-year period here, 2025 and 2026, in aggregate, not just this year. So the markets are quite disconnected here from what the Fed is envisioning. We can see what consequences this has wrought in markets. So from September, when they issued that dovish forecast, we have seen inflation expectations as measured in the bond market, break-even rates. We've seen them move higher. We've seen the dollar has gone up. We've seen yields have gone up at the front and the back end of the curve. These are the 2-year note and the 10-year. And of course, we've seen the yield curve in the yellow bars here steepen significantly. But now the real question is this chart here, just to go back. Because if the Fed is saying we've got 100 basis points in cuts over 2025 and 2026, and the market is saying, no, it's half that. You've got a cut this year and a cut next year, not 2 and 2. And one wonders what the next point of adjustment in a hawkish direction could look like. Because the next step, at least for 2025, let's say, next year is still a ways away. Lots of things could happen. We have a new administration coming in, taking the reins of power in the U.S. next week. And whatever you might think of the ups and downs of its various policies, they do all seem to be inflationary, boosting economic growth through the lowering of taxes, as we saw the last time that this administration was there, the first Trump administration, and boosting growth further through deregulation, that's inflationary because faster growth brings more inflation. As more money changes hands, inflation rises. Now, the situation around tariffs and immigration, which ostensibly beckons a shock to labor markets if there were mass deportations, say, those details are murkier, and we don't quite know exactly what's going to happen, what can actually be put to work. But at face value, tariffs amount to a sales tax on imports, and reducing the supply of labor ought to increase the cost of labor, which ought to increase the cost of things produced by that labor downstream to the consumer. And all of those things, again, at surface level, without knowing the details, just the trajectory of those policies, that's inflationary. And so, ostensibly, it's still quite a bit out there for us to figure out, to really get a handle on these dynamics. But if CPI comes hot in this release, the markets will have to ask themselves, does it make sense now that the Fed has very clearly signaled an intent to gradually reduce interest rates, perhaps at a slower pace than they did last year? And in fact, the minutes from December's FOMC meeting very clearly suggested that the Fed intended to be more gradual and slow moving relative to last year. But given the Fed's very overt intent to cut interest rates this year, how reasonable would it be, knowing all of what we don't know about what comes next, as we've just discussed, for the markets to say there will be no cuts in 2025? Because indeed, with only one cut now on the menu, that's the path of the next hawkish adjustment, were one to happen. And this is where things get interesting. If you get a reasonably manageable CPI number, that is, a number that is perhaps even a bit warmer, maybe we get to 2.9 and 3.4%. Maybe we get to 3 and 3.3. Something relatively modest, but nevertheless biased higher. If that occurs and there isn't a massive further acceleration in yields, there isn't a massive further acceleration in the dollar, there isn't essentially the next leg in this dynamic, and the market is more circumspect because of how much of an adjustment has already occurred, well, then we might have reached that move's zenith. We might be looking at a peak of sorts. And so we might get to a place where the market has bought the rumor but will sell the fact. And as long as the CPI numbers aren't completely off the reservation high, the market might say, well, what are we going to do? Say the Fed is not going to cut at all? We're already down to only one cut. Are they really going to mark an about face that quickly? And are we going to show conviction in that idea without the Fed having said anything of the sort? That might be a limiting factor. And that could be a bottom in the bonds after a long, long sell-off. Obviously, this rise in yields is the flip side of that is a sell-off in the bonds. And of course, the flip side of this rally in the dollar is a sell-off in it against its major counterparts. So if a reasonably warm CPI number that nevertheless is within the realm of the acceptable does not give us a yield surge and a dollar surge and things remain relatively anchored, that loss of sensitivity could be very telling indeed for what markets do over the weeks that follow. And that is Macro Money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I'll be on in just 30 minutes time from now, as I am now every Tuesday with Victor Jones for The Price of Truth, on with Chris for Futures Power Hour on Mondays and Fridays, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter, as well as on Blue Sky. If you're watching on YouTube, like and subscribe. Thanks very much for watching. Macro Money's back tomorrow.